Welcome to the Foundry, where leaders are forged daily. And now your host, George Roberts.
Welcome back, entrepreneurs. Today we have Stefan Tsvetkov, founder of RealtyQuant. Welcome, Stefan.
Hi, George. Thank you for having me here today.
It's great to have you. And I have a lot to ask you about your company. You're putting out a lot of amazing data. I know you have three wings to your company. You've got the education, you've got market picking, and then you've also got some property data that you're putting out as well. I understand you're focused on the properties. So tell us how you're picking properties. How are you using machine learning to do this?
Mm-hmm. Yeah, that's a great question. And so that comes to the topic of, I guess, what I call data-driven real estate investing. So what is data-driven real estate investing? So for myself, at least, what this means is actually, automated underwriting is one big piece to it. So what I do on my side, I would pull residential and commercial properties on market, off market. So it could be from various listing services like Proxy, Redfin, etc., or off market from social media, Google, and other places, and kind of like search for deals. So that's kind of like relatively just like the data extraction piece, but then try to model them as well as possible and try to like underwrite them end to end. Now, to the goal of this, there's like a few additional sort of machine learning pieces that are useful to actually achieve automated underwriting. So one is condition scoring. There are a few companies that do that for visual side for images. I don't have it built in at RealtyQuant as far as the computer vision side, but I do have the natural language processing side. So I have like NLP models that do the textual classification of like various property descriptions according to different criteria. And condition scoring is one of those criteria. It's a very useful one because essentially what it means is if you want to, not be manual about underwriting, thousands of deals, let's say, you want to do it like in an automated manner. So what is really missing for you? So you can pull all the data, you can do calculations, but what's really missing is like somebody looking at those images, somebody reading the textual descriptions, right? And both of those problems are solved in data science already. So we're at the stage we don't need to be doing it manually. And so I've been doing it for the textual side in-house, and I've been looking at some vendors like Foxy AI to potentially incorporate like the visual side. So that's kind of as far as one part. So that's automated underwriting. Then there is also a side of because for me, like I come from, just like for your audience, like a little bit of background, I used to be a financial engineer for an insurance company. So I used to trade derivatives. So I was a trader. So I come kind of out of a trading background. And so for me, like when I started in the real estate industry was, okay, how can I trade the real estate industry like financial markets and discover inefficiency in the market in a very like data-driven optimized way. Now, many markets, like in top primary markets, like be it Atlanta, Georgia, or New York City, and so forth, have a degree of efficiency to them. They're still not perfectly efficient, but let's say fairly, generally speaking, one pays the market value there. But there are other more illiquid markets where it's not the case. And so one thing I've been doing in more my residential investing career, and I've been, switching fully to the commercial side, but in my residential investing career is actually like doing sort of like zero's estimate, but in-house. So it's like a machine learning model to like price properties, and it's very high level. It's not super accurate, but it is useful in markets where prices can be really off. Sometimes they're kind of like very kind of all over the place in very spotty liquid markets. For example, things like places like upstate New York, because I'm from New York City. And so essentially, so that is automated valuation models is another data-driven piece. Then there's various market side things that we can talk about. And then there's some modeling that can be done. Like let's say stay on the property side. Commercial multifamily, one thing I found extremely useful and what I use now transitioning fully into the commercial space is actually, if you think about how the commercial multifamily industry works now. So we have, it's agent relationships, probably 90%, right? And then perhaps like the rest 10% is some kind of off-market direct to owner, or let's say there's 9% and maybe 1% is like on-market listing services or like WhoopNet and so forth. And so essentially for that direct to owner piece, instead of, let's say, like picking a market and going to a vendor like Prospect Now or whatever, and like picking a single county and like gearing your direct to mail campaign to them, what I do myself is actually kind of do my own modeling. So I would pull like various properties online from rental listings data. And so that's, that came down with Python or with other programming languages. So it's sort of like scouring the web for that. And by having rental listings data, it's extremely powerful because that gives you the opportunity to actually model commercial properties preliminarily. And essentially what you're doing is you have like thousands and thousands of properties and you're sort of doing preliminary analysis of their income expense sheets to determine if they have value add. So to determine if you're able to realize an upside in their appraisal. And that's basically what a value add investor, call it, such as myself, is really looking for. And so that's not going to be super accurate, but in the end, you have kind of like a vector of, let's say, 1,000, let's say it's in a single market, 100 large commercial properties, 100 units, 200 units, 50 units, etc. And you have them kind of ranked by which ones have the more value add and which ones don't. And the reason why this is a little bit available in a preliminary sense is because, well, rental listings data can tell us if rents in a given building are below the immediate neighborhood for the same asset class, for the same property class, let's say. It can also tell us whether other income components like rent, pet fees, administrative fees, etc., are being charged more or less relative to the immediate neighborhood and property class, and can tell us even what utilities are being built. So this is kind of like a wealth of data to have as far as analyzing commercial properties, which are driven off NOI and which are driven off income and expense. And it is a very preliminary view, but then once you take this approach and you do it across markets, and once you append to it like all market data, and I'm going to get into that as well, you have a more powerful approach where now you're picking, even if you do like a direct to owner campaign or be it whichever approach, you actually are now picking, across multiple counties. Let's say, I don't know, like my direct to owner campaign. I'm not saying that's the most efficient way. Of course, agents are. But let's say my direct to owner current campaign, I think it's like is in 150 different counties, in like different states, because I'm kind of pretty agnostic. And I know real estate is local and there's like many considerations, but as far as trying to do a more data-driven approach for direct to owner, so that is what I have. And then in addition, within those counties, it has really picked only commercial assets that show potential in their NOI. And that's like by public available information online that is, accessible to anyone. And it is just like, it takes work to harness, obviously, and so forth. So this is another like data-driven technique, I would say, or modeling on the commercial side. So to kind of sum up, we have automated underwriting, things like condition scoring, like additional models, automated valuation models, and we have modeling for different things as well. And I believe I have a few other things on the property side, but let me think. So I think that is a good summary. And then on the market side, I can talk to that, George, also, if
Sure.
Would be of interest.
Yeah. Well, here, let's back up a little bit. So
yeah, sure.
the first buzzword that I heard you use was the NLP, or natural language processing. So there's a lot that you can do with that. I mean, I got a listing up here while we were talking, and it's just funny, all the words that people use, right? They use things like cozy, if it's small, or quaint.
True.
And you see words in these listings like updated, right? Updated or new. This gives you some idea. It's more for the residential, I think, than the commercial, those sorts of listings. But just to give you the idea, for those people that have not been out there, working with natural language processing. These are things that people do, for example, in social media. You can look and you can see whether people are saying nice things about your product or not. So you're getting in there and you're getting, this is one of the things that gives you the idea that, hey, this is an updated property, or maybe this is one that has more value add.
Exactly. That is correct. Yeah, that is correct. But you can really also use it for various other classifiers. Like be it trying to discover like a property situation that you're just curious to have. I don't know if you can add an additional unit, or like there can be like certain other useful, I don't know if it's a double address or it has multiple properties within it, and like it's kind of like different, like different things that that might be part of your investment strategy. So really, like for me at least, back before when doing like exclusively the residential real estate investment in a data-driven way, for me the approach was, okay, let's have all the data and then underwriting and all those different strategies. So okay, it's not like just all compute your cap rate and this and that, but really, okay, right. If I want to look at one thing I've done is like condominium conversions in like the New York City area. So for example, like, okay, if I want to look at like condo conversions, let's try to find this kind of arbitrage, in the market. And so underwrite properties on those strategies as well. So it really allows you the flexibility to kind of have multiple strategies that you lay over as well. And you're able to underwrite like this. So this is another benefit. And yeah, so NLP, to your point, I think the real meaning for me of NLP is, okay, it's like humans reading. So it's kind of automating human intelligence, right? So that's where kind of, I guess, the artificial intelligence part is, is not heavily inaccurate, right? Since that is really what is happening, and you don't need to have an analyst reading those descriptions. And for example, I can give like a reference for this. I used to do this like in a very simple way, like kind of like you mentioned, that you have like keywords like quaint, let's say needs, TOC, things like that, and kind of classifying by those like very critical words, the condition, by call it like regular expressions, they call it, this kind of old method in computer science, like when you have like, just like kind of matching patterns of words, right? And so, and one would think that that's like kind of fairly accurate. But then once you build kind of like an NLP model, you see that even a very simple NLP model performs just as good as, building really elaborate expressions yourself. So it is powerful, and it is also very easy to build and kind of easy to implement. And of course, it's not like for everyone, who likes to do this kind of stuff, but it's, there are vendors who do it. And specifically, like I mentioned, on the images side, there's a very good vendor out of New York City called Foxy AI that I've checked their stuff, and it seemed like accurate, at least for images that I tested. And it seems like kind of accurate in the sense aligning with our intuition, right? As human beings. So kind of like the way I would assess it, it seems like, oh, that's kind of quite in line, with that. And so that's what we are really after here. Like our predicted variable is how a human would assess those properties. So, which may not be perfectly accurate, but as well, there's no objective kind of thing there or reality, but this is, this is the approach. But I think the general thesis there is, okay, I can, I guess, view it from let's say, look at the opposite. What is not data-driven for me? Let's say, obviously manually underwriting deals in itself is not data-driven, even though it's necessary. It is necessary, and even to a point that I now have been working very hard to find an acquisitions analyst to help me to work jointly with the systems and that. So it is definitely necessary as well, but in itself is not data-driven. And another thing that's not data-driven, by the way, a little less obvious, is when many people look at like markets and midi-chap reports and things like that. Now they're in themselves, they're derived in a data-driven way, but if I look at them, I don't get intuition about the data, I don't interact with it, and I may not act so much on it. I may not have put like such high trust and deep understanding, with it just by looking at the report. So in itself, using only reports, like without interacting with the data, in itself, the reality and the truth is not data-driven for me, at least. And then it's also utilizing let's say, no risk management. That's another piece. Now, I feel like in real estate, like we hear a lot of like investment management where, how to say, like where markets are selected in, and we can get to the part of how to pick markets, basically, I guess, if that would be appropriate. And so I can
Sure,
go on
that would be perfect. But I just want to make sure we just back up a little bit. I don't know if everybody is really schooled in finance. You mentioned efficient markets, and something you didn't really underscore was the fact that you are tying all this into market data. So you're able to figure out where the under market rents are. So you can see where there's some likelihood of upside. A lot of people like to say things like CoStar and Proxy. I mean, these are where deals go to die, but you're not analyzing 1 or 5 or 10 a day. You're looking at thousands a day.
Are you ready to build passive income through investing in multifamily real estate? Take the next step by heading to www.horizonmultifamily.com and click Get Started to schedule a call.
Yeah, for the commercial, on the property side, for the commercial real estate, it's, when you say I'm working, it's still a difficult job. So actually, that's why I do need an acquisitions person, because it's actually still hard to even look at the data feeds and so forth, right? So it's not so easy to implement. It's not like, it's, you have all this data and then you're just going to, have like humongous deal flow and so forth. I'm sure there are people who do things manually who have more deal flow than me. So in that sense, I'm pretty humble about that, to be honest. Right. But the truth is, as far as just the analytics being available, yes, on the commercial side, it's really like, I think I did a lecture at my webinar where I had 32,000 or so like commercial multifamilies assessed on if they have potential to improve their value add in a and these are like 200 unit buildings, 50 unit buildings and so forth. So this is a very good approach generally to scale. Now, for most people, most investment managers, they don't have an interest in this kind of approach because let's say they have their fixed market, let's say they're in Houston. And so that's it. But if you think of it if you attempt to kind of scale to a more broad, like kind of data approach, where you would be able to evaluate your markets in this way, and ultimately you would have to fly there before the purchase, of course, and so forth. But then it becomes this kind of exercise of really evaluating many properties, like you said, for if they have below market trends, if they have their other revenue and expenses optimized. It's really many insights. One can get insights into the occupancy of those buildings and so forth. And it's all, data that is out there that is really available from rental listings, for instance, for this specific model. And then there's also social media, like we discussed. On social media, there is lots of deals that one can find as far as just scouring social media and doing it if you take something like a Facebook group, let's say, right? And suppose you're looking at that, following that Facebook group, checking for deals yourself, do it pretty hard. If you then go as far as like extracting all those posts in an automated manner, you're going to find there's so many more posts you have missed, and there are like thousands of them perhaps. And there's just much more stuff out there. And so this is really the concept, but it's easier said and harder to integrate it into your business. And you need a team perhaps to do it and so forth. So that's kind of like where some of my effort has been as far as expanding that, because I find it also very overwhelming, and I found myself building all those models and stuff, but then it's really hard to run them, look at the feeds, do all that stuff. It's a lot of work. It's really a lot of work.
Yeah, data science is extraordinarily busy job. A lot to it. I remember building some models myself outside of my career, and when you find all of the ways that the data can be mismatched, incorrectly, or even just unevenly gathered, it's I'd say that's really the hard part. Once you figure out how to smooth out your data, the algorithms take care of a lot. Absolutely,
yes, I agree. Absolutely, yeah. The cleaning of the data, figuring out inconsistencies and so forth. Yeah, that is absolutely correct.
So let's pivot a little bit into economics, and I think this will go right into or dovetail with the market choosing. And obviously, there's a lot going on in the economic sphere right now. We've got inflation. There's been a lot of money that's been printed. inflation is tearing through the economy in a very differential way. Some places we're seeing a lot more inflation than others. And what's probably most important to us is figuring out which markets have room to grow in terms of rents. So that's a lot to throw out there. I'm just sort of defining the defining the scene there. What are you seeing in terms of inflation and other economic factors and how they're going to impact us?
Yeah, this is a great question. So, I mean, one thing, so that comes down to like market valuations. So it's a topic that I've covered quite a bit, at my own content online and other events as well. So for me, like what inflation did is this did seem to like change the market regime, call it, for real estate to an extent. And I can explain what I mean. So it's really up to 2021, even the first quarter of 2021, there were like various publications on different countries and how real estate is under, over, fairly valued and things like that. And one of these publications is by Bloomberg Economics, by Niraj Shah, is the name of the economist there who publishes it. And so Bloomberg Economics was showing US real estate as fairly valued. And then there are some other ones, one at Florida Atlantic University, there is Local Market Monitor, there is the Fed, like Federal Reserve Bank of St. Louis, has an economics unit that does also some kind of housing bubble analysis in a way. And so those were like publications that were, and I was doing it at this time as well. I actually started at the beginning of COVID for the interest of my own investing, assessing, if markets are over, under, fairly valued, and so forth. And so all these different sources were showing US real estate as fairly valued at the time. It's quite interesting because many people thought that, say that many investors say, okay, real estate is overheated, it's so hard to find deals, it's overvalued. But in purely like fundamentals perspective, up to as far as the first quarter of 2021, US real estate, broadly speaking, was fairly valued. And there was a pronounced exception of Idaho at the time. So that was the only one. And I was even in 2020 at the beginning of COVID and different events, and I was sharing my perspective as for Idaho being kind of the only sharply overvalued state, around 25% overvalued at the time already. So that started like in 2020. And so what inflation did, just coming back to this, so we had like a very fairly valued US real estate in comparison to other countries where, for example, Bloomberg Economics was reporting Canada as very overvalued and was reporting New Zealand and Australia. They have this kind of countries analysis, like on 4 different metrics. And New Zealand, Australia overvalued as well. And then they had Sweden, like some Scandinavian countries, and to some extent the United Kingdom. So they were actually all like way higher in that. And the US was like right around 100% in, for example, affordability and things like that. And so it was, so that is where, again, we were at the time. And then suddenly in 2021, so it came like the second quarter of 2020 and the third quarter of 2021. And I was tracking this data quarter after quarter, actually. And it was always the same. So I started like at the beginning of first quarter of 2020, and I keep tracking it. And it's always like in very close numbers, like valuations were not changing. So, and to give a perspective, further perspective to that, for example, Florida and Texas, they were staying at like the positive 8 to 10% range, roughly speaking, or 7 to 10% for one of them. And so it was those are numbers that were actually very, very stable. And so what inflation did, and this is at least my perspective and what I see in the data, is that it made some of those numbers kind of double. So in the second and third quarter, by the end of the third quarter of 2021, Florida and Texas went from like, let's say 7-8% to now 17-18%. And that's not so high, but then something like Idaho that was at 25 already, then jumped to like 47. And, like Arizona was around 15 and jumped to 30. So it had an impact in some of them, how do I say, like just Western and Southern markets only, primarily. And then the Midwest and Northeast, now they remain, like the Northeast remains undervalued until now. And when I say undervalued, this is really only a downside risk measure. It's just where prices are relative to their fundamentals. It's a predictor of downside risk. It's not a predictor of appreciation at all. It's a very poor predictor of appreciation, in fact. And predicting appreciation is based on, like other factors. And actually, I can talk to that as well. I believe like the best method is looking at the price time series themselves. Now, considering one adjusts for stationarity and like all those like more technical terms, let's say, but other than that, like looking at predicting the prices of the price histories is a more accurate approach as far as forecasting. And again, yes, so inflation for me, it led to an increase in market valuations. And the reason is because fundamentals didn't move accordingly. So you had like assets really grow. And like, I know you mentioned rent growth, especially like with the rent growth, like some of the commercial asset values growing a lot, but fundamentals didn't. And even wages, I just put like Bureau of Economic Analysis, I believe last week, published their wage data for year end. They lag by about like 3 months in that. And wages in the fourth quarter of last year, they grew by 0 or 1% in different states. It's like it wasn't much. So I was expecting, okay, are we going to see a wage boost suddenly, with all the inflation that we're having? But no, that was just 0 or 1%. And prices, on the contrary, if we look at something like Florida, for example, prices in the fourth quarter grew by 5.5%. And so that's going to drive valuations further higher. So if Florida was at around 17% now, I haven't published like the new data on that, but it's going to go to probably 21% overvalued. And this, to give a perspective, it's not that this is over a very short time. This is where it was at, 7-8%, like several quarters before that. And so it's a very short time that things started getting overheated. And I think inflation is a driver. And some people could say, okay, you have all this money supplying to the system. And so that's not going to create a bubble, if you will. Well, okay, sure, let it, obviously money supply has to go somewhere, but then if fundamentals don't move accordingly, that's not going to stay together, just the general expectation. So then the question is, are wages going to move like that? Are like sort of less dollar value dynamics, such as population and housing supply, that you cannot assign a direct dollar value, but are they going to move accordingly? So population to housing supply ratios in different markets to be also predictive of the same appreciation, because that's a big factor in like market valuations. And besides income levels, is actually like housing shortage and like population to housing supply ratios. And so this is for me the effect of inflation. So it's made things like, I would say not more precarious, well, definitely more precarious, and like kind of having higher downside risk in Western and Southern markets. And in places like the Midwest, they're still fairly valued. So if you go to Kentucky or Indiana and so forth, it's fairly valued. And if you take something like the Northeast, it's probably going to stay fairly to undervalued even until the end of the cycle. That would be my guess, which was at least before the global financial crisis, there were Texas was undervalued at the time, and other like about 10 states were undervalued at the time in this kind of like fundamentals measure. And so this is what I see. It's very interesting. So for me, 2021 kind of marked a change. And so I was now, okay, I kept tracking those things. I say US real estate is fairly valued, that was kind of my narrative. And now suddenly, it over just like a couple of quarters, like just 6 months or so, it changed. And it's not so bad yet. I mean, just to give a perspective, before 2007, US real estate relative to its fundamentals, again, like here fundamentals, it means income, population, housing supply. That's all that I am assessing, like nothing else. Relative to its fundamentals was very fairly valued in 2002. And then between 2002 and like right around 100%, that's it. And then between 2002 and 2005, it went in certain markets to like super overvalued, just in the course of like two, three years. And so now we're just showing the first sign of this kind of change in like kind of like sharp change in regime, if you will. So it can take, like 2-3 years ahead or 4 years. There's really no timing to it. But the question is, and one, there's no timing to it. Two, it's not that it makes me bearish on, let's say, a Western market if it's quote unquote overvalued. Now, it's actually quite the contrary. Like I've spoken on Boise in Idaho, for example, is a city that is like the top performing city this market cycle. And then we have Phoenix and Denver and other places. But then Boise in Idaho, happens to be very overvalued as well. And so if I run like 1 year ahead price forecasts as well at my company and for own use, let's say. And so those price forecasts, which city they show to be the best, to do best over the next 1 year, assuming the same trend continues. Well, it's Boise in Idaho. Even for as far as time series forecasting, there is no model that is extremely advanced that is not just going to follow the trend and so forth. There's just none so far. There are no particularly complex machine learning models for time series forecasting. It's actually, a lot of the models are pretty old, like ARIMA and ETS and so forth. And so it's quite I'm simultaneously extremely bullish on Western markets while we're in the same cycle, and simultaneously understanding that they carry very high downside risk after the end of this cycle. And now there are scenarios in which, because now this is calibrated, the way I've built even this model is calibrated to the declines past the global financial crisis. And like, and just to give some more perspective, like these fundamental based measures, they were predictive of like declines post the global financial crisis to about 85% correlation at state level. And then for 2,700 US counties, the predictive power was about 75% correlation to the actual subsequent declines. This is so kind of crazy. I found it before when I discovered this, because these are the actual declines, and those declines in some markets, they are very small. Like the average time it took to hit bottom was like 4 years and 1 quarter. And so we have like markets that are bleeding out to their fundamental level, essentially. And even more, some of those markets were growing in population, for example, like in Nevada. So in Nevada, population was exploding in 2000 to 2010, and that did not prevent prices to fall by 56% in Nevada to come back to their fundamental level. So this is something strong. There are reasons to this. So it's not a and so the predictive power on the downside seems to be pretty high now. But there's a scenario where we do not experience, and I think I read a publication today from like Federal Reserve Bank of St. Louis, again, like their economics unit, I believe, where they were arguing that we may not experience such a strong correction, let's say this time, for this and that reason, and so in a way. That is possible, because if something is overvalued, let's say relative to fundamentals, you can have, let's say the fundamentals, let's just call them income for simplicity. Let's call it only income, which income is a huge driver. And so if something is overvalued relative to income, it doesn't mean that prices are going to correct. It could be that we experience prices become stagnant. Let's say they just grow slowly and income gradually catches up over a long period of time, let's say a decade. Or it could be that income experiences a super growth. That was actually my hope now with inflation. I was just hoping, okay, some of Western markets kind of grew overvalued. Hopefully, perhaps wages catch up. And that with this kind of super growth, and you see like 5% wage growth in a single quarter or something like this, or at least 2-3%. And so that is another scenario too. So in theory, prices don't need to correct and in specific small markets, that has been observed very well in the past. That was the case in Washington, D.C., in fact, I think during the global financial crisis, which dropped relatively little and was quite overvalued at the time in fundamentals terms. And it just followed like a different dynamic. But it's just hard for this to happen for something as big as states. That is at least my perspective. We have something like Texas and Florida, these kind of large land masses, and they show like 20% deviation from fundamentals. That to me is a meaningful, like statistically valid thing, because, predictive power there seems to be pretty strong. And so, this is this is just my commentary on the economy or like this with regards to real estate and what is happening from my perspective, because I know like real estate investors, they say that how inflation is good for hard assets. That is correct. And okay, because you mentioned rent growth, and rent growth, was like double digit in, these markets, and commercial real estate assets really, really exploded in value. It's a combination of rent growth and also compressed cap rates. And so that is, I don't have specific predictors for rent growth, just FYI. In that sense, that's something I don't I don't model myself so well. I don't think I have like as good data. Perhaps it's something that I would look for in the future, like to expand into. But yes, I mean this is just like a summary that I have.
Right. Let's go back to that downside protection, because you cited some figures that were really amazing. When you look at the downside protection, I think what you're doing here is you're looking at the deviation from the 20-year moving average home price to income.
This is, yeah, George, yeah, this is the easiest way to do it. Exactly. That's I've spoken like other lecture. If one looks at like price to income is like home prices to relative to personal income in an area. So that's like affordability, what we call affordability. And yes, so this is the simplest. It's not because of just income. It's a very interesting thing, because when you do this kind of deviation from affordability, you inherently capture housing shortage. And that's something I've like discussed, because like affordability moves over time with housing shortage. And that's and so this is so it's an interesting dynamic. So it's really not just incomes, but if you do that, that has very high predictive power. Yes. So if you just take like changes in affordability, that works. And that works just as a proxy to the true dynamic of fundamentals, which include also population and housing supply. But yes, when taking this kind of difference variable, you account for it inherently. Just it kind of works well, you know.
Right, which is another very important general principle, that having more inputs to your model doesn't necessarily make a better model.
Yes.
You mentioned that income is a proxy. Obviously, you have people moving to an area, then you have to pay more if you want to get be appropriately staffed, etc. It could be a proxy also for the household appreciation, or maybe vice versa. But there's a lot of things going on in there when you just look at income increases. If people making more money, then home prices are going to go up, makes it harder to buy, and then you get more renters. But anyway, I think maybe I'm getting a little further afield. What I really want to do is get back to the state of Texas. I think you mentioned that they were slightly undervalued going into the Great Recession.
Correct.
And there is such a high correlation. As you mentioned, I think it's 85% on the state level and 75% on the county level. So how did Texas fare coming out of the Great Recession?
Yes, so that's a great question. Yes, so where is that? So I mean, that was just the correlation back then. Now we don't know what's going to be in the future, but that was to clarify the correlation between how overvalued markets were in this kind of deviation from affordability and the subsequent actual declines. And yes, so Texas was 5% undervalued in this, and it had a 4% decline at the time. And it's and actually, so there were 10 states that were undervalued, Texas and others, and their average valuation was minus 4%, let's say. No, sorry, never mind. Their average price decline was 4% after the global financial crisis. And so, and also like the median income at the time in the US, like with the global financial crisis, income levels dropped as well, to like by 4%. And so one can say in price income terms, things didn't drop actually in undervalued state. This is extremely interesting. So we have the biggest financial crisis decline, but if you take the undervalued places and you take how they perform, it's stunning how their prices in normalized terms stayed the same. So price to income ratio stayed the same, roughly speaking. So that is like very interesting. So in Texas that happened, and that was like very well seen in real life. For example, I had Vinny Chopra, my webinar, and so he did his first syndication deal in 2008, and he had like this very high IRR. It was apparently a good opportunity, a good project. But if you think about like so many other syndicators who at the time, and I've listened to lectures like this on podcasts, different podcasts, and so forth, there were so many syndicators who actually lost all their net worth. There's, for example, like Rod Cliff, where he speaks, that's his lecture topic, right? Frequently, like how I lost 50 million past the global financial crisis and then made them again, right? And so the reason why it didn't happen for Vinny, for example, is he was in an undervalued county in an undervalued state at the time. And undervalued counties in undervalued states, even during the global financial crisis, they didn't drop. And this is one can compare this again to the stock market. where you don't get this kind of dynamics. You don't get the dynamic where there is there's more stickiness to the downturn, I feel, in real estate. Like prices don't just drop. People don't just sell their houses because, the news are saying that there is the global financial crisis happening. And so if the market fundamentally is okay, even if the news are saying that there's a global financial crisis happening and so forth, those markets in price to income terms stay the same. And so that is kind of the commentary there. And that's where that correlation is really coming from, because what that showed, like where you see it in the numbers, is you have those 10 undervalued states dropping only 4%. But then on the other end of the spectrum, you have California, Nevada, Arizona, and Florida, which were the 4 states which they were like 40 to 60% positive, above their historical affordability, let's say. And they declined similar. They declined like 40 to 56%, was pretty close actually. And so that is the meaning of that correlation. That's like kind of like, so it was actually, it's like easy to see, and I have like some kind of maps and stuff, and this like kind of to show like how it actually looked. And then at the county level, it's harder, much harder to predict. So like smaller markets, it's harder. So something that is, when we say 75% correlation, maybe it sounds high, but it's actually not, it's obviously statistically relevant, but it's not, it's, when you look at the numbers, you see it's like, the numbers are different, at the county level. It's not so easy to predict like all those small geographies. But yeah, so that was kind of the dynamic there. So at least for me now, it has been, okay, how do I pick markets in this framework? Well, it becomes a question of risk tolerance, where if I want to go to the southern market, if I want to go to Florida, okay, considering their market valuation keeps growing quarter after quarter, but let's say they were at 17% as of the third quarter of last year, and now growing perhaps into 21, as I mentioned. And so, but let's say they were at 17%. So I can consider, well, I can invest still there, but I need to keep tracking all those metrics. And that's something actually we do and publish at RealtyQuant at my company, that we publish this market valuations data. And in addition to that, also offer kind of a lifetime subscription for investors, where not lifetime subscription, no, lifetime free updates, we call it, lifetime free updates. So they're actually able to see, okay, if their market that is, for example, if it's now fairly valued, they're able to see if at some point in the future this changes, and kind of to keep tracking it. So let's say what I would do in 4 days, I would still invest there, but I would just be aware of that I'm buying in a more overvalued market, that I carry this downside risk, and kind of perhaps try to time a 2 years forward exit and so forth. But it is, of course, higher risk. I could even, but then also considering that real estate has momentum, so it has very high autocorrelation in most states, not everywhere. Like Alaska had negative autocorrelation, like it's actually negative momentum. Last year price performance, working as if like negative correlation to this year price performance. But in most other places like Florida and Texas and even Massachusetts and so forth, the correlation is very positive between if price performance was good, it continues being good. And so one can invest in those markets because one would expect to pick up really high appreciation over these 1, 2, 3, whichever number of years. But one should just be aware of that, one simultaneously carries this downside. So just there's no really bad market, even now, it just becomes a question of risk tolerance. Where do you want to enter in those very high appreciating markets? And then there are markets that have done well, and they were still under or fairly valued. For example, even like if you take I speak very much of states since it's a general discussion, but obviously one looks at cities, and I have the data at county level, right? So for example, if we take the state of Indiana and there, Indianapolis and like different markets within, or let's say Kentucky, like Louisville, Kentucky, for example. So some of those markets are still fairly valued actually, even until now. So if one goes in Indiana, the state has had like very healthy price appreciation. It's not depressed like the Northeast, and it's not so strong as the West, and it's not so strong as Florida as well. But price appreciation since the last fair valuation cohort has been healthy, and so one can go in such markets. So one can go in a very overvalued market that performs very strong as well, and know that one is carrying this risk, or one can go in a fairly valued market that these things tend to correlate with price performance already at the end of, if we are indeed towards the end of the market cycle, I don't know. But then, okay, if you go in a fairly valued market, it has performed kind of average, one can go there too, or one can go even in like completely depressed market, like the Northeast call it, and like play on like a market neutral strategy, if you will, and just like try to execute like different value add and improve properties and so forth, and know that you can do this forever and it's just going to be fine, because there's nothing that's going to happen to you as far as the market side. And so so this is really just really a question of risk tolerance at that point, and you want to try to squeeze out some more appreciation, and which likely is going to be really strong if you go to Phoenix or something like that, but are you concerned about a downturn? And that's it. Mm-hmm.
All right, awesome. Well, I want to get you out of here because we've been here for quite a while and it's very fascinating. I have more questions to ask you about the housing shortage and appreciation investing versus investing for cash flow. But I think we should probably head into our lightning round. And how about this? Let's start with what's some advice you would give your younger self?
Well, I would have given myself the advice to get into private equity earlier. Get into private markets. Don't stay in like public equities too long where you cannot develop as an investor, I would say. Get into private markets. It doesn't need to be real estate. It can be even venture capital or other fields, but where you can understand to an extent, have some degree of understanding of like company valuation and other things, and where you can have a discount and find a deal and so forth. So that's what I would have just done it like way earlier for myself.
Outstanding advice. Public markets are crowded for a reason. Private equity is a whole lot less crowded.
Yes.
I love a lot of the options that are available in private equity. Now, as a data-driven real estate investor, you must hear a lot of real estate advice out there that's off, maybe a little bit or maybe a lot. What would you say is the worst real estate advice that you hear commonly circulating?
Oh, well, the worst one, that's an easy one for me. Like to me, the worst one is something of the kind, buy, let's say Houston assets or something, like buy into X market, which is it's a strong market, and see if that market currently is strong and it's not susceptible to a downturn. That's not how that works. In fact, some of the strongest markets, when identified by investors and market participants and so forth, they're likely to become very susceptible to a downturn. And so that for me is kind of like some of the worst advice, because that is not a measure of downside again. Yeah. Mm-hmm.
Great. You got to be a little bit of a contrarian. If we all chase each other like lemmings, danger.
Mm-hmm. Mm-hmm. Yes, exactly.
All right. Well, how about the best advice that you see circulating, or the best advice that you would give?
I think incorporate downside measures in your investing, data-driven approaches. And obviously that is kind of what I stand for here in that sense. And that is, another good advice is just like look for alpha, as they call it in real estate, like try to understand markets, even if it's real estate markets, better, and know if you're investing for just like mimicking the market and kind of getting a little bit of value out and mimicking the market, or do you have a true inefficiency to your true investment alpha, as they call it, to your investment opportunity. And I think like sometimes some investors get a little bit confused, or at least they don't focus so much on the second one. And at least to private investors, I think that is a good advice. There's just so much alpha out there. There's so many great opportunities. It's harder to do it for investment management because it gets, as capital increases, then things get constrained. But for every private investor out there, in your audience, I think they should seek that. And there's so many opportunities there, and the market is not sufficiently overheated. There's still opportunities, and there will be.
Great concept. So alpha, as you began to describe, is your excess return, not just looking at the volatility or looking at how hot the market is, but showing literally how much have you brought to the deal, or how well have you sifted through the deals to find the good ones.
Exactly.
All right, let's name a book that's helped to forge you as a leader and as an entrepreneur.
I'm not super big on business books, to be honest, but like I know I liked The Richest Man in Babylon.
I have that book. I still have to finish that.
There was also, what was there? There was like how genius failed. Hedge fund code, like
Controls, right?
Kind of. Yep. Exactly. Yeah. There was
Wow.
some of them were there. Yeah. Exactly.
Tell us how we can reach you online.
Yeah. RealtyQuant.com.
All right. Thank you so much, Stefan.